If you've got around $100,000 sitting in your savings account or spread across random investments, and you've been thinking, how can I turn this into something that actually pays me, something that could replace my income one day? You're already thinking in the right direction. This is where dividends come into the picture. Because dividends aren't just a bonus some companies throw your way. They're one of the most reliable, predictable, and consistent ways to build long-term passive income. And if done right, they can be your first real step toward financial freedom. Now let's slow this down and really understand what this means. When you buy a stock, you're buying a piece of a company. If that company makes profits, it has two main choices. It can reinvest the money back into the business, or it can share a portion of that profit with you, the shareholder. That shared portion is called a dividend. Some of the most reliable established American companies, think Johnson & Johnson, Coca-Cola, Procter & Gamble, or PepsiCo, have paid dividends for decades. Not only that, they've increased those dividends almost every single year. These companies are often called dividend aristocrats because they've proven their ability to keep rewarding shareholders through recessions, wars, inflation, and every kind of market condition. Now let's put this in your context. You've got $100,000 to invest. You want to make it work for you. You're not looking to gamble. You're not looking to day trade. You want something that can give you real cash flow year after year. So the question becomes, how do you turn that 100K into a reliable income stream that grows with time and eventually gives you the freedom to stop worrying about your job or paycheck? Let's run through the math. As of 2025, one of the most popular dividend ETFs in the United States is SCHD, the Schwab US Dividend Equity ETF. It's one of the go-to choices for dividend investors because it holds some of the strongest American companies, focuses on dividend quality, and charges a super low expense ratio. Now in 2025, SCHD trades around the $75 to $78 range per share, and its dividend yield is hovering around 3.7% to 4% annually. That means for every $100 you invest, you're earning about $3.70 to $4 in dividends every year. So if you invest your full $100,000 into SCHD today, you're likely to earn around $3,700 to $4,000 a year in dividend income, which is roughly $300 to $334 per month. Now, that might not sound like a life-changing number yet, but this is where the real power of dividend investing kicks in: growth and reinvestment. Because if you take those dividends and instead of spending them, you reinvest them, you buy more shares of SCHD, then next year you'll own more shares. More shares mean more dividends. That cycle keeps repeating year after year. This is called compounding income, and over time it becomes unstoppable. Let's put this in a more realistic scenario. You start with 100K. You invest it in a quality dividend ETF like SCHD or a mix of dividend growth companies. You reinvest your dividends. You also add a small amount of fresh capital every month, maybe $500 or $1,000. You do this for 10, 15, 20 years. You're not trading, you're not chasing hype, you're just letting your portfolio quietly grow and compound. In the first few years, the results seem small, but over time something magical happens. Your dividends start to earn dividends, and that's the moment your money starts to work for you. Now let's talk about why dividend investing is so powerful compared to just chasing stock prices. When most people invest, they're focused on price. They buy a stock hoping it goes up so they can sell it for a profit. That's fine, but it's unpredictable. You can't control market sentiment. You can't control timing. But what you can control is buying into businesses that pay you regardless of short-term price movement. Think of it like buying a rental property. Some months, real estate prices go up. Some months they go down. But if your tenant keeps paying rent, you're still making money. Dividends work the same way, and they're like rent checks from the companies you own. Now here's the mindset shift that separates true dividend investors from short-term traders. When prices drop, most traders panic. But dividend investors smile because when prices go down, yields go up. You can buy more shares for less money, locking in higher future income. That's the key difference between price focus and income focus. A price-focused investor says, "My portfolio's down 10%. An income-focused investor says, "My portfolio's paying me $500 a month now instead of $450 last year." See the difference? One is guessing the future. The other is collecting cash today. But let's stay practical. You're still wondering, can a 100K portfolio really lead to financial freedom? The answer is yes, but not overnight. It takes discipline, time, and reinvestment. If you consistently reinvest your dividends and your holdings, grow their payouts by, say, 6% per year on average, which is roughly what many dividend growth ETFs have delivered, then your $4,000 annual income becomes $4,240 next year, $4,500 the next, and so on. Within 10 years, without adding a single extra dollar, your dividend income alone could climb above $7,000 per year. Add in reinvestment and new contributions, and that number can compound dramatically faster. The beauty of this strategy is that you're not relying on luck. You're relying on math and consistency. Dividends might sound slow, but they are one of the most predictable wealth-building tools that actually work for normal people. You don't need insider info, you don't need timing, and you don't need to be glued to your screen every day. Instead, you focus on the 3 pillars of dividend investing: yield, growth, and quality. Yield gives you immediate income. Growth gives you future income. Quality keeps that income safe. You can't build financial freedom with just one of those. You need the balance of all 3. For example, a company paying 8% yield might look tempting, but if that dividend isn't sustainable, it could be cut, and your income collapses. On the other hand, a company paying only 2% but increasing it every year by 10% might be a better long-term bet. That's why many investors prefer ETFs like SCHD, VIG, Vanguard Dividend Appreciation ETF, or HDV, iShares High Dividend ETF. They give you diversification across dozens of top-tier dividend-paying US companies without needing to pick individual stocks. Now let's zoom out. What does financial freedom actually mean in this context? It's not necessarily about being a millionaire. It's about having your expenses covered by your income streams. If you can make enough in dividends to pay your bills, you're financially free, even if you're not rich by society's standards. For example, let's say your monthly expenses are $3,000. That's $36,000 per year. To cover that entirely with dividends at a 4% yield, you'd need a $900,000 portfolio. That sounds big, but it's not impossible. Especially when you start early, reinvest your dividends, and consistently add to your portfolio over time. Starting with 100K is a huge advantage. It gives you a head start most people never get. And the key is to protect that base, grow it, and never interrupt the compounding process. Now, let's talk about the mindset part. Dividend investing is boring, and that's exactly why it works. It's slow, steady, and predictable. It doesn't give you dopamine hits like crypto or meme stocks, but it gives you something way more powerful: peace of mind. You wake up knowing your money is working for you. You know that as long as you own solid businesses, you'll get paid every quarter. That consistency changes how you think about money. The challenge is, most people quit before the compounding really kicks in. In the first few years, it feels too slow. But think about planting a tree. You don't see much at first, but after a few seasons, it grows roots so deep that nothing can stop it. That's your dividend portfolio. Now let's be real. There are risks. Dividends are not guaranteed. Companies can cut or suspend payouts. Even SCHD's yield can fluctuate as interest rates, profits, and market conditions change. But that's why diversification and patience matter. Never rely on one stock. Never chase the highest yield. Focus on reliable companies with a track record of paying and increasing dividends through all market cycles. If you've already started with that $100,000 portfolio and you're collecting your first few $1,000s a year in dividends, the big question now becomes, how do you turn this beginning into something meaningful, say $1 million of invested capital, and enough income that you can truly call yourself financially free? Let's walk this through with clarity, practical numbers, and a disciplined process. No hype, just math, and repeatable steps. Step 1. Choose a core dividend vehicle and lock in current yield as your baseline. We'll use SCHD for illustration. As of 2025, SCHD has a dividend yield of about 3.8% to 4.0%. Let's pick 3.9% as a working number. That means on $100,000 invested, you get $3,900 per year in dividends. Step 2. Decide whether to reinvest dividends, DRIP, and/or add new capital. If you simply let that $3,900 dividend payout be spent, your income stream is stable, but your base portfolio doesn't grow much faster than underlying business growth. But if you reinvest the $3,900 back into SCHD or similar dividend vehicles, then next year you'll own roughly $103,900 worth, simplified, ignoring share price changes. On 3.9% yield, you'd then get $4,051 the next year, and so on. That's compounding in action. Better yet, if you add new capital each year, say $5,000 per year from savings, the base grows faster. Step 3. Build a model, projection over 10 to 20 years. Let's assume the following. Initial investment, $100,000, yield, 3.9%. Kept constant for simplicity. Dividend growth, increase in payout per year, 5%, reasonable for many ETF dividend growth companies. Additional contribution each year, $5,000 all dividends reinvested, DRIP. We'll project approximate income and portfolio value after 10 and 20 years. Year 1, $100,000 x 3.9%, $3,900 dividend. Add $5,000 contribution. New base $108,900, assuming reinvestment. Year 2, base $108,900, payout grows 5%. Yield on base 3.9%, but payout increases so income $3,900,105, $4,095 plus new contributions, etc. Over 10 years with these assumptions, you could roughly double or more your base investment, and your dividend income might increase to 8 to a 10K year or more, depending on share price appreciation and payout growth. Over 20 years, assuming stable conditions, your base could grow to 250 to 300K or more, again simplified, and your dividends might reach 10 to 12K or more per year. This is meaningful. Step 4. Raise the yield or raise contributions to accelerate. If instead of $5,000 a year, you add $10,000 a year, or if you target a yield of say 5% with higher risk, your numbers change significantly. For example, 100K at 5% yield, $5,000 a year initially. Add 10K year contributions plus dividend growth. You might reach 20K a year in dividends in 10-15 years. The key variables are starting base, yield, contribution rate, and dividend growth. Step 5. How to reach $1 million invested. If your goal is to have $1 million invested in dividend-paying assets, you need a combination of starting capital plus consistent contributions, plus dividend reinvestment, plus time, plus dividend growth. For instance, if you start 100K at 10K per year, reinvest dividends, you could reach close to $1 million in maybe 20-25 years, depending on market returns and business growth. Once you hit $1 million at 3.9% yield, that gives 39,000 year gross dividends, and if you achieve 5% yield, you'd get 50,000 a year. That might cover a comfortable lifestyle if your expenses are moderate. Step 6. Real-world example and reference to SCHD's data. As mentioned, SCHD yields about 3.83% presently. Its dividend has been growing, historical growth, approx 7 to 10% annualized over the past years. It also carries a low expense ratio, 0.06%. This kind of fund shows how one core vehicle can serve as the engine for long-term dividend income. Step 7. Tracking your progress. Yield on cost, income milestones, and risk checks. Yield on cost, YOC. Suppose you bought at $100 share and dividends were $3 share, then your YOC is 3%. But if dividends grow to $4 share and you bought at $100, your YOC is 4%, even if current yield is 3.9%. Tracking YOC shows how your income is improving independent of market price. Income milestone targets. Set a goal, e.g. 10,000 year in dividends, then 20k, 30k, etc. Work backwards. To get 20k year at 4% yield, I need 500k invested. Risk checks. Are dividends increasing? If a payout cuts, why? Is yield creeping dangerously high, maybe unsustainable? Are you too concentrated in one company or sector? Are you ignoring inflation? Dividend growth must beat inflation over time. Step 8. Adjusting strategy if things change. If yields fall across the board, interest rates, macro conditions, you have 3 levers. Increase contributions, invest in higher yield but still quality assets, or extend your timeline. If you're behind schedule, you might shift into dividend growth stocks, lower yield now but higher growth, or add a small allocation to higher yield vehicles with extra risk. If you consistently reinvest dividends for 10 years and avoid withdrawing, the compounding snowball effect gets strong. Each year, your dividend income earns its own dividends, your contributions buy more shares, your base grows, and one day you cross that meaningful income threshold where you're no longer working for every dollar of income. Income works for you. Step 9. What financial freedom looks like with dividends. When your annual dividend income covers your living expenses, or a large portion thereof, you're financially free. For example, if your annual expenses are $50,000 and you have a dividend income of $50k a year, you could choose to stop full-time work. With $1 million invested at 5% yield, you hit that. The important part, the income is passive, coming from your portfolio of dividend-paying assets. You don't have to sell shares to generate income. The companies pay you. Because you've reinvested and grown the portfolio steadily, the income stream is sustainable and ideally increasing each year, thanks to dividend growth. That gives you choice, freedom, security, not just wealth for wealth's sake. Step 10. Summary and what comes next. You now understand how to go from 100k to something much larger by systematically using dividends, reinvestment, contributions and time. You have a model. Choose a vehicle like SCHD, understand its yield and growth, reinvest, add capital, track progress, adjust when needed. You have a goal-oriented mindset instead of chase mindset. All right, let's pick up right where we left off. We've already built a strong understanding of how dividend investing works, how SCHD and similar ETFs fit into a portfolio, and how $100,000 can begin your financial freedom journey. Now, in this part, we'll explore how that money can actually grow itself, slowly, silently, and powerfully, through the magic of compounding dividends. Let's start simple. Imagine you've got $100,000 invested in SCHD, and as of 2025, the yield sits around 3.6%. That means you're earning roughly $3,600 a year in dividends, without touching your principal. Now, if you choose to reinvest those dividends instead of spending them, you're buying more shares of SCHD every quarter. Each new share then earns its own dividend, and the next quarter, your total dividend check grows just a bit larger. This is how the snowball starts. At first it looks small, an extra few dollars per quarter. But as time goes on, that small snowball picks up momentum. By the time you hit year 5 or 10, your dividends start compounding at a rate that feels almost unfair. Let's visualize this with real numbers. Suppose SCHD grows by an average of 8% annually, and you reinvest every dividend. After 10 years, your $100,000 could grow to around $216,000. That's more than double your initial investment. without you adding a single extra dollar. And the dividend income? It rises from around $3,600 in year 1 to more than $7,500 per year by year 10. Now imagine you do keep adding. Let's say you invest an extra $500 per month. That $100,000 portfolio could reach over $330,000 in a decade, generating nearly $11,000 in yearly dividends. That's the power of consistent investing and compounding combined. But it's not just numbers, it's psychology. When you invest in dividend-paying assets, you start to think differently about your money. Instead of obsessing over price fluctuations, you focus on income generation. Every time the market dips, instead of panic, you see opportunity. Great, now I can buy more shares at a discount, and they'll pay me more income forever. That's the mindset that creates financial freedom. Here's the truth. Most people fail in investing not because they choose the wrong stocks, but because they can't stay calm long enough to let compounding work. Dividend investors, however, have an advantage. They're rewarded for waiting. Every quarter, even when the market is red, those dividends still roll in. It feels like being paid to stay patient, and that's exactly what it is. Now, let's talk about real-life examples of people who did this. Take Mark, a 42-year-old engineer from Texas. Back in 2010, he started investing $500 a month into dividend ETFs like SCHD and VIG. He didn't chase hype or trade trends. He just stayed consistent. Fast forward to 2025, his portfolio crossed $600,000, and he's earning over $20,000 a year in dividends, enough to cover his mortgage and utilities. That's not luck. That's discipline, time, and compounding. Or Susan, a retired teacher from Florida. She inherited $80,000 and decided to put it into a diversified basket of dividend ETFs and REITs. By reinvesting for 15 years, her income now exceeds $1,800 per month, passive income she can live on comfortably in retirement. These are not overnight stories. They're slow, steady, real. Another key to success is reinvesting intelligently. If you're using a brokerage like Schwab, Vanguard, or Fidelity, set up automatic dividend reinvestment, called DRIP. It ensures every dividend gets reinvested instantly. No emotions, no delays. This tiny automation helps your portfolio grow quietly in the background while you focus on life. And don't forget taxes. In the US, most qualified dividends are taxed at long-term capital gains rates, not ordinary income rates, meaning they're tax-efficient income. That's another reason why dividend investing beats keeping money in a savings account. But remember this, the secret isn't just in the numbers, it's in your behavior. When markets crash, and they always do, dividend investors have an emotional anchor. They look at their holdings and think, I'm still getting paid. That steady stream of cash flow helps you ride through volatility instead of bailing out. That's why dividend investors are among the least likely to panic sell in a downturn. In other words, dividends turn you from a speculator into an owner. You're not just hoping the price goes up, you're owning a slice of businesses that pay you for life. And one more thing, don't underestimate time. If you start early, even with small amounts, your snowball grows exponentially. $100,000 at 8% annual growth turns into about $1 million in 30 years, even if you never add another dollar. That's the long game. But most investors never make it that far. They quit after a few years, switch strategies, or chase hot stocks. The patient ones, though, the ones who understand that slow is smooth and smooth is fast, they win. Every single time.